Greetings, everyone, and welcome to this month's edition of Girard's Monthly Market Update. I'm Senior Vice President and Wealth Advisor Jim Jacobson, and with us again today is Chief Investment Officer Tim Chubb. Thank you for tuning in, everybody. So, Tim, what a year it's been so far. The COVID-19 bug hit. I like to call it the beer-battered bat stew, not to make light of it. It's very serious, and it derailed, at least temporarily, the capital markets around the world. It certainly derailed our stock market as well as many others, and in fact has pushed us into the deepest recession since the Great Depression. Unemployment has been coming down the last 2 months, but it is still over 10%. And we're still battling now another round of outbreaks in some of the southern states. And yet the NASDAQ is hitting all-time highs, and the S&P 500 index is within just a few percentage points of its all-time highs. So I don't know about you, but I say we just gear down for the rest of the year and take the rest of 2020 off. What are your thoughts?
Yeah, that sounds good, Jim. I mean, it's hard to believe that it was January where, we were dealing with the U.S.-Iran tensions. We had the impeachment, Olympics being canceled, the unfortunate death of Kobe and his daughter, and then, of course, the murder hornets. So another 6 months, my friend, will be there. But yeah, what a year it's been as we sit here in July, climbing out of the global recession that was induced by COVID-19. First quarter, we saw U.S. GDP, gross domestic product, the goods and services we produce as a country decline about 5%. And it's expected that in the second quarter, as we get data here in the next couple of weeks, that we'll see GDP decline somewhere in the 30 to 40% range, which can't say I've ever said it ever in my career, or anyone could have said in their career, because it'll likely be the sharpest and shortest recession that we've ever seen as a country, going from meltdown to melt up in a really short period of time. And the same is true for the capital markets. Back in March, we were having all sorts of liquidity issues within the corporate bond market, with the municipal bond market, in equities. We saw declines in the S&P 500 almost exceed 30%, get close to 35%. And thanks to the massive amount of stimulus, both from the Federal Reserve and also, Congress through PPP program and the like, they've spent $2.44 trillion, or the equivalent of about 12% of U.S. GDP so far, to help prevent this biological crisis become a financial crisis. And so I think obviously we're on our way out of this, and I'd say the economic data is improving much more quickly than I would have anticipated, but there's still a lot of risks on the horizon.
All right, so that's a good look at the front half of a crazy year so far. Let's take a look at the second half. What are your thoughts on what could be on tap as we roll through summer and then into fall?
Yeah, as I mentioned, we're technically in a technical recession. So a recession is at a minimum 2 consecutive quarters of declining GDP growth. We'll likely only see 2 quarters of declining GDP growth in the third quarter that we're in now, that began July 1st. We'll likely see GDP really jump, potentially go up to 15% for the third quarter, and continue to grow pretty rapidly for the fourth quarter as we climb out of this hole. Overall, for the full fiscal year, I think we'll see 6 to 7% decline in the goods and services we produce as economy year over year for 2020. But as you mentioned, and as we already mentioned, May jobs report's been strong. The economic data has been improving very quickly. I think we'll go into January next year looking at unemployment rate of somewhere around 10%. We had been in the longest economic cycle that we've ever experienced. Unemployment rate was what we would consider beyond full employment, under 4%. And I think overall, the labor market should continue to improve as long as we're able to balance both reopening the economy safely and, of course, keeping COVID-19 case growth to a minimum. But I think significant risks still exist as we enter the second half of this year. The markets do not like uncertainty, and like most elections, I think we'll have a lot of uncertainty come November. But like I said, the high frequency data related to TSA volumes, restaurant bookings, mortgage applications are all meaningfully off the lows. And so perhaps the tailwind that we have from an economic growth perspective will lead the markets to feel a little bit more comfortable depending upon the outcome that we'll see in November. And I think that the biggest thing is, we will continue to have support from the Federal Reserve. The plan is to keep rates low and not unchanged through 2022, which is weird to say. And despite the partisan bickering that we'll likely experience over the summer, I think we'll see continued sort of stimulus from a fiscal policy perspective, which should remain supportive of the markets and the economy.
Yeah, and it's going to be interesting to see how this plays out longer term, because in theory, we could have some higher inflation, we could have some higher taxes, and I don't want to get into the politics of it, but there is the debt. and all those things will come into play as we go forward. But again, that's all long term, and we have to get to the long term first. So when I look at more of the shorter term, I always like to kind of think of it as putting my eyes through a telescope into the sky, and what do I see right away? Things like opening schools this fall. I think that's very, very important, not only for our nation as a whole, but also for family structure and the psychology of all that. And then once we get into that, you mentioned the election. So we'll have schools opening in August, September. Then we get into the election in November. Certainly, there's going to be a lot of, I don't want to say angst, but there could be some high emotions with that, let's say. And I know in a future video, we're going to talk about the variability of those types of things, and does it really matter which party gets elected, so on and so forth, from a market standpoint, not from a philosophical standpoint. And then after that, believe it or not, we'll be rolling into the holiday season. And I think that's going to be a very fascinating time to see if people will be traveling en masse and getting together in the traditional way, or whether we'll be having our turkey dinners around the old video camera, saying hello to Aunt Jan and poking fun at Uncle Charlie and trying to keep the political jokes to a minimum. But all that has yet to come, and we have to get there first. So in the meantime, we encourage our viewers to check us out at meetgirard.com. That's MEETGIRARD.com. You'll see a whole list of our comprehensive services there, including investment management and financial planning. Also, we will be doing our quarterly Investment Currents Live presentation on Wednesday, July 22nd at 1 o'clock. We'll post the link to that presentation on our website, so be sure to check that out. It was very popular when we did it in March. We're bringing that again here for July. And again, our goal is to help you achieve your financial goals, whether they be simple or complex, short-term or long-term. So get in touch with us soon accordingly. All right, friends, thank you for joining us again today. Stay well, stay balanced. Thank you, Tim, for joining. Enjoy the summer season, everybody, and we look forward to talking to you again next month.